They want you to believe the global financial system is under control. They want you to believe that price discovery is rational, that supply meets demand, and that the regulators have their hands firmly on the wheel. But when the second largest economy on Earth suddenly pulls the plug on its entire silver market to stop a panic, the facade crumples. This wasn't a technical glitch. It wasn't a holiday. It was a desperate emergency intervention to stop a financial contagion from spiraling out of control. And if you think this is just a China problem, you are missing the single most important signal the market has flashed in years. Let's strip away the noise and look at the raw data of what actually took place. On January 30th, Chinese financial authorities didn't just tap the brakes. They slammed them to the floor. They issued a full-day trading suspension for the UBS SDIC Silver Futures Fund. Now, context is everything here. This isn't just one of many options for Chinese investors. This is the only public fund in mainland China that allows direct investment in silver futures. For 1.4 billion people, this is the primary door to the silver market. And the government nailed that door shut. But they didn't stop there. In a coordinated move that screams systemic risk, 4 separate OA-focused funds were also frozen. This wasn't a coincidence. It was a calculated strike against a wave of capital that was threatening to break the market infrastructure. You have to ask yourself, what terrifies a regulator enough to shut down the market? The answer is a phenomenon that usually precedes a total collapse of confidence in fiat currency, the premium spiral. To understand why this matters to your portfolio, we need to dissect the mechanics of what broke. Under normal conditions, a fund tracks the price of the asset it holds. If silver goes up 1%, the fund goes up 1%. Simple. But when panic buying sets in, when the desperation to exit cash and enter hard assets becomes overwhelming, the mechanism fails. The demand for shares outstrips the fund's ability to buy the underlying metal. In Shanghai, this imbalance became grotesque. Investors are paying a 36% premium over the actual value of the silver. Let that sink in. People were so desperate to own silver exposure that they were voluntarily handing over $136 for $100 worth of metal. They weren't buying silver anymore. They were buying a lifeboat, and they didn't care what the ticket cost. Regulators looked at this mania, saw the mathematical certainty of a crash when those premiums normalized, and decided to kill the momentum before it wiped out the retail sector. However, dismissing this as over-enthusiastic retail traders is a dangerous mistake. This is a symptom of a much deeper fracture in the global economy. We are witnessing a synchronized flight into hard assets that defies the standard economic models. Look at the charts. Silver hasn't just rallied, it has exploded, surging nearly 60% in a single month. We are seeing price levels that would have been laughed at a year ago. Gold is chasing all-time highs. Oil is breaking resistance. This is not random price action. It is the market pricing in 3 specific, converging threats that the mainstream media is largely ignoring. First is the chaotic oscillation of interest rate expectations. The market is whipping back and forth between fearing inflation and banking on rate cuts. This volatility destroys confidence in the dollar, and when the dollar looks shaky, money runs to metal. The second driver is the geopolitical powder keg. We have naval vessels repositioning in critical choke points. We have escalating tensions in the Middle East. Energy supply chains are looking more fragile by the day. When smart money sees warships moving, they don't buy tech stocks. They buy oil and gold. The Chinese investors rushing into those suspended oil funds weren't gambling. They were hedging against a world on fire. The third factor is the one that makes this a long-term structural crisis rather than a short-term trade: the physical shortage. We are trying to build a green energy infrastructure, solar panels, EVs, 5G networks that is fundamentally addicted to silver. Governments have mandated a transition that requires more silver than the mining industry can dig out of the ground. When you combine an industrial supply deficit with a monetary panic, you get a super spike. That is what the Chinese regulators saw coming, and that is what they tried to pause. But here's the truth about market interventions. They are temporary dams against a rising ocean. You can suspend a fund, you can halt trading for a day or a week, but you cannot legislate away the demand. When you lock the front door, the capital doesn't evaporate. It flows to the back door. It flows to the physical market. It flows into the physical market. It flows into offshore accounts. It flows into gold. We are already seeing the spillover. The gold to silver ratio is compressing aggressively. Historically, when this ratio drops fast, it signals that silver is moving from undervalued to fairly valued, and often overshoots into mania. At the same time, physical dealers are reporting shortages. Sales of silver coins and bars skyrocketed by triple digits in some regions. Search traffic for how to buy silver is vertical. This is a mass awakening. People are realizing that paper promises are infinite, but physical ounces are finite. Now, we must apply some critical thinking. When a market goes parabolic, when premiums hit 36%, and when your taxi driver starts giving you silver tips, we're usually near a local top. The easy money has been made. The dumb money is the money that pays a 36% premium because of FOMO. The smart money is the entity selling to them. If you are looking at this market now, you have to distinguish between the signal and the noise. The signal is that the global financial architecture is struggling to handle the demand for real assets. The noise is the daily price fluctuation. The Chinese shutdown tells us that the system is fragile. It tells us that when the herd moves all at once, the gates close. This brings us to the psychology of the trap. Imagine a crowded theater. Everyone smells smoke. There is only one exit. The first few people get out calmly. The next group starts to run. The last group finds the doors locked because the management is trying to prevent a stampede. That is what happened in China. The regulators locked the doors to save the crowd from crushing itself. But the smoke is still there. The lesson for the individual investor is clear. Do not wait until the panic is visible to position yourself. If you are trying to buy insurance when the house is already burning, you will pay a premium that destroys your capital. The time to acquire hard assets is when the market is boring, not when it is halted. We also need to look at the oil connection again, because it reinforces the thesis. The fact that oil funds were suspended simultaneously with silver proves this isn't about a specific metal, it's about the commodity trade as a whole. It's about a rejection of paper assets. When geopolitical risk rises, commodities are the only asset class that acts as a true hedge. The Chinese retail investor knows this. They are trend followers, yes, but they are also reacting to a reality where their currency feels less safe than a barrel of crude or an ounce of silver. So, what happens next? The capital that was blocked from these funds will seek new homes. We will likely see continued pressure on international spot prices as that demand leaks out of China and into global markets. We will see the physical market disconnect further from the paper price. You might see the spot price of silver dip on the charts while the premium to buy a physical coin stays high. That divergence is the hallmark of a stressed market. Ultimately, this event serves as a stress test. It exposes the fact that the paper derivatives market the funds, the futures, the ETFs, is a leverage-based illusion that works fine until everyone wants delivery of the real thing. China just showed us what happens when the illusion breaks. They hit the kill switch. In the coming weeks, watch the regulators. If we see more suspensions, more margin requirement hikes, or more restrictions on trading, it confirms that the authorities are losing control of the narrative. They can pause the game, but they can't change the score. The fundamental drivers debt, war, and scarcity remain unresolved. Most dangerous thing you can do right now is assume that because the trading has resumed, the problem is fixed. It's not fixed, it's just been delayed. The pressure is building behind the dam. Smart investors are not chasing the 36% premiums. They are quietly accumulating the assets that will be left standing when the paper market finally admits it can't cover the check. Stay skeptical, stay liquid, and watch the premiums. They are the only honest signal left in a manipulated world.